Welcome back to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Gergella.
My name is Phil Tripotowski.
And I'm James Sibco.
All right, February 2026. Things are weird. They're definitely weird. We are fresh off of NADA show 2026. Hell of a time it was there in Las Vegas, Nevada. We're going to talk dealership performance, consumer sentiment, tax returns are on the way. They're big, but what percentage of the way are they returned, if you will? And I will. Negative equity rising, but the percentage of actual vehicles that are in negative equity is actually not nearly as high as you probably think. But if you are in negative equity, you're probably very much in the red. And then GDP and inflation outlook. My esteemed colleagues have an action-packed episode for you today.
If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support.
These are some very interesting numbers here, looking at month over month and year over year. And when dealers ask me at NADA, hey, what does your aggregate data look like? I go, I don't really know what to tell you, except for there's traffic. Buyers definitely want to get a vehicle, but the apprehension is as high as I've ever seen it, except for maybe during the couple of months directly after COVID, when the automotive market was not born yet. You can see here that new sales, this is our largest individual month drop in the history of the Automotive Market Minute. Are we surprised? I'm not surprised whatsoever. Am I surprised at the amount that it's down? I suppose I could say, yes, I'm a little bit surprised there. Did I also see a lot of dealers that not necessarily wrote off the month, but when we had the Arctic vortex that came through, that also kind of ruined January. A lot of dealerships closed for multiple days. I know this also discouraged salespeople. So I want to be clear, the numbers are ugly, but there's also extenuating circumstances in which lead to these numbers. But something that I want to talk about here, used continues to be very resilient. Market day supply continues to hang out around 45 days. And year over year, you can still see that used vehicle sales are actually up. So if your dealership is highly dependent on used vehicles, you most likely had a pretty decent January in general in comparison to a regular month. But there's a lot of red here. There's a lot of concern in the marketplace. And just a few days through February has also showed that the concern has continued thus far, but there's some good stuff coming.
Nationally, we saw the sales volume for January come in at 1.11 million units. That's higher by 0.6% against January of last year. Now, keep in mind, January of this year, of 26, did have one additional selling day. This year, we are seeing the used vehicle segment still remain competitive. Now, keep in mind that Winter Storm Fern, especially across our dealer base, really ended up disrupting conditions for much of the nation. And that really did put a damper on many stores' volume in the month of January. And one thing that we wanted to call out on this episode in particular is look at consumer sentiment. Put yourself in the consumer's shoes right now. The consumer sentiment graph that you're seeing here is currently bouncing off a decade-long level of resistance. Typically here, we start to see consumer sentiment rebound and start going the opposite way. That means a more positive consumer. Now, with that in mind, James, where are we at with the tax return season so far in 2026?
It's tough to see that consumer sentiment chart at a 50-year low. So tax return season, which we think will be a great one this year, is off to a very average start. It's a 5 out of the last 10 years. It's right at the average of the last 10 years, and it's behind the last 2 years, but we're really all waiting for day 54. Day 54 is when they bring the check paper to the check printer or it gets unjammed or something there at the Treasury. That's when they really start ripping out the tax refunds. So everyone should be managing everything toward that 54th day of the year, toward that weekend. And how? That's when the tax returns start to show up. We've got some good news about the tax returns as well, or at least we have an administration that's going to give us some good news before the news actually happens. They're telling us, and this is the average of 3 or 4 different sources, including from the White House itself, we're probably going to have about $900 more per tax return check that comes to a consumer we're going to set a multi-decade record here for tax returns, including the COVID years. And so get excited about that. But we do have to talk about where those tax returns are going to go. Yes, they're going to come onto the lot. Yes, they're going to be primed to buy a new car, but they're going to be driving something in to the lot. And Stephen, how would you summarize this chart? Because they're going to help plug this gap.
What I'm going to expand on here at the end is that there has to be a proactive methodology at your store when looking at the fact that in 2019, there are actually a higher percentage of people that are walking on your lot with negative equity. It's the amount that's much worse than it was before. So this is where we've got to make sure we train our salespeople, our finance managers. Hey, your percentage is not this crazy amount. It was higher in 2019. But when you're getting hit with negative equity, you're 30 to 40% higher than you were before. There's the graph here. You can see in Q1 2024, you have a 7% of all people over $15,000 in negative equity. Let's fast forward just a couple of years later here, and let's go to 9%. And we all know that that number is also rising. Now, what's even tougher is people that are buying used vehicles that are fairly expensive. And of course, they're at a 15% rate. Rolling back CAFE standards and these other moves we're making, we have years to be able to let this thing wash out and get consumers better used vehicle prices, better new vehicle prices. So this pain is not going away for 24, 36 months.
Yeah, we're still 2 years away from the improved fleet of vehicles that are going to finally come and meet all the different types of consumer demand. Just a reminder, what manufacturers were doing is they were manufacturing EVs that nobody wanted so that they could sell as many SUVs as they possibly could and make the most money. And everything between a tiny EV and a giant SUV was just forgotten and neglected. And now the fun part is that we're going to see cars everywhere from a big SUV all the way down to a small compact car with everything in between. It'll be easier to sell and more consumers will walk off the lot happy with a different type of a car.
Yeah, and to add one more thing here, I have an unnamed source in the front office at Ford that I had a discussion with at NADA. And put simply, they knew the Ford Lightning was going to be a failure. That is a great example. Unless your name is James Hong, you're not stoked about the Ford Lightning. And if you know, you know, but they knew it was going to be a failure. And I also had another individual that I spoke with from Volkswagen. And I think I've said this on other Automotive Market Minute. I keep thinking that these people are so freaking smart at the factory level. I think that they're just so intelligent because there's billions and billions and billions of dollars moving. And then I look and I go, you made all these EVs. You knew that the depreciation was going to be astronomical. You fed the consumer a $7,000 rebate, which isn't nearly enough to cover the depreciation cycle that's about to happen. And now, let's look at people. Let's look at my brother-in-law who just purchased a used Audi EV. I believe his sticker price was $153,000. And if I'm not mistaken, he just purchased it. I believe it's 2 years old. I think he paid 70.
Every EV produced was enabling 2 SUVs to be sold. It's something other than money was driving this. It was these credits and the CAFE standards. I'm going to be really excited to be able to throw all of this on the dustbin and forget it ever happened.
It also looks like a lot of the manufacturers have very much opened their eyes to the hybrid model and how valuable the hybrid model is going to be. This is in discussions with people from Mazda, from Hyundai. I'm very confident that hybrids will be on the rise and that EVs, while may seem sexy when talking about it, doesn't feel that way when you go to trade it in 3 years later.
James, talk to us about the economic forecast and what this looks like for the nation moving forward.
These are big upgrades of the economy for the fourth quarter 2025 that we just saw in the first couple quarters of 2026. These are giant moves. This is recent data as recently as last week. Wall Street economists just marking up their real GDP growth. And this is 2 factors are probably driving this. One is inflation is falling. So there's 5% of nominal growth, but there's less inflation. That means real GDP goes up because it's nominal growth minus the inflation rate. So when that falls, real GDP goes up. The second piece of this puzzle is the trade deficit's falling as well. The Trump tariffs are working and people are buying US made stuff more and imports less. And that's a plug. And so that plug drives this up as well. So a lot of GDP growth. And where's it manifesting itself? Where's that GDP growth coming? This is a really cool chart. This is a monthly chart of what everyone thinks GDP growth is going to be at the end of the year in 2026. So, okay, great. What do your next 11 months look like? Well, all of that is consumer growth here, practically. That's the blue line here. So just better consumer and consumption-led growth. So our customers, even though as we went over at the first part of the market minute, are complaining, at least they're spending. So they're spending and complaining while they spend.
And the outlook for inflation, what are we seeing?
This is a pretty standard chart of our standard economic measures, be they CPI or the Fed's favorite wonky deflator. The good news is that we're having inflation, the rate of change of stuff, go down. But the next slide is really interesting. It's from our friends at Trueflation. Trueflation set up their inflation indicator because they felt like the government was cheating, and that for many decades, and probably provably so, the government was releasing inflation numbers that were too low. Well, when I see the Trueflation index, which is updated weekly, which is a little bit more dependable, which is weighted the same way that CPI is, when I see it falling off a cliff like this, all the way down to numbers that are unfamiliar to someone who's familiar with the US economy, I take note. This is a fast moving line. I think it moves around the inflation lines that are on the chart in front of us. So I think we are going to be going into a 2026 that is going to see good growth with low inflation. It doesn't get much better than that in terms of an environment for consumers and selling cars.
James, for those of us that have no clue what's going on in this chart, can you explain what these lines mean?
The yellow line is CPI. The green line is the number that the dorks at the Fed like to use. And the white line is Trueflation itself. And you can see the Trueflation line is something that moves faster, and it's something that drags the other ones around. And we gave it to you first, and we're telling you that those lines that everyone are going to be talking about next month are going to be following.
So if I'm a car dealer, I can go, okay, the white one is more of a true guide to how inflation's actually going, and it looks to be coming down faster than we're being told. Is that a fair takeaway?
Absolutely.
To close things up in February, I want to give everybody a reality check on the trade-in market. If you look at the percentage of people walking onto your lot underwater, we've actually seen worse. In 2019, more people were technically upside down than they are today. But back then, they were underwater by $4 or $5 grand, as I mentioned previously in this episode. Today, that number has exploded to a record $7,214 on average. That is the difference between a deal that's, quote, tough to pencil and a deal that's impossible to fund. And I know many dealers I've had discussions with feel this on a daily basis. We're talking about this record-breaking tax season, over $4,100 on average hitting bank accounts. It's a massive win, but don't let your teams get lazy as we approach this day 54. That $4,100 refund doesn't wipe the slate clean anymore. It only covers about half of the negative equity hole. Your mission for the rest of February is to solve the $3,000 gap. The traffic is there. Used traffic is up 33% year over year, as I mentioned. The cash is coming. Day 54 is right around the corner. That's the middle ground. But dealers who win this spring won't be the ones just waiting for the tax check to show up. They will be the ones that have trained their desks to use that refund as a bridge, not a total solution. You have to be better at appraisals, better at inventory selection, and better at restructuring than you've ever been. The money is coming, but the math is harder. Let's make sure your team is ready to work. On behalf of my esteemed colleagues, Bill Trebetowski and James Sivko, my name is Steven Georgella. I am as passionate as ever going into March. We'll see you on next month's Automotive Market Minute. Out.